All right, today we're going to try and decode the financial story of TD Synnex. We're going to look past the stock ticker and see what's really going on with its performance, its price, and its overall financial health.
Okay, let's just start with this one, kind of mind-blowing number. This is the company's total return to investors over the last 15 years. Yep, you're seeing that right. Over 1,500%. A number like that, well, it definitely makes you want to look a little closer, right?
But of course, a big flashy number like that never, ever tells the whole story. What's actually driving this performance? Is it sustainable? And what does it mean for the company today? Let's find out.
So here's how we're going to tackle this. We're going to look at the company through 3 different lenses. First up, performance. Then we'll look at its valuation. And finally, its financial health. By putting all those pieces together, we should get a much clearer picture of what's going on.
Okay, let's start with lens 1, performance. We already saw that monster 15-year number, but what was the ride actually like for investors who held on?
Well, as you can see, it has been anything but a smooth, straight line up. Just look at this. A massive 64% gain in 2019, but then, bam, a 16% drop in 2022. So yeah, the long-term trend is definitely up, but boy, it's been a bumpy ride.
And this is where things get really interesting. The 5-year average annual return is a solid, almost 14%. Pretty good. But look what happens when we zoom in. The 3-year average jumps to over 35%. And the last 12 months, an absolutely insane 107% return. The momentum here is it's accelerating like a rocket.
Okay, so when you see performance like that, it immediately begs a really important question. So let's switch to our second lens, valuation. Is this price tag actually justified by the business, or is the hype train just left the station?
One of the most common tools we can use here is the price-to-earnings ratio, or PE ratio. Basically, just think of it like a price tag on the stock. It tells you how many dollars investors are willing to shell out for every single dollar of the company's profit.
So the big question is, has that price tag been going up? Oh yeah, for sure. Right now, the PE ratio is sitting at almost 19. Now, compare that to its average over the last 3 years, which was closer to 15. That means investors today are paying a premium of more than 27% compared to what they were willing to pay just a couple of years ago. The market is clearly feeling a lot more optimistic.
But hold on, because this is where the plot really thickens. On one side, you've got the market price, what the stock last sold for, about $227. But on the other side, we have a calculated fair value, which is based on what we think the company's future cash flows are worth. And that number? It's just under $105.
Whoa,
that is a huge difference.
And that gap leads us to this pretty shocking number. What this is showing is the margin of safety, and it's a negative 118%. What does that mean? Well, this particular model is basically screaming that the market price is more than double what the company's fundamentals seem to justify. And that right there is the central puzzle we're trying to solve. Okay, so with that massive question mark about the valuation just hanging there, we absolutely have to pop the hood and look at the engine itself. Let's move to lens 3, financial health. Just how strong is the actual business that's supposed to be supporting this sky-high stock price? All right, first things first, let's check for risk. How much debt are we dealing with? This chart shows the debt-to-equity ratio, and it comes in at 0.54. To put it simply, for every dollar of its own money, the company has about 54 cents of debt. That's generally seen as a pretty manageable level. No major red flags are waving here.
But okay, not having too much debt is one thing. The real question is the business any good at actually making money? How efficiently is this thing running?
And you know what? The answer seems to be, yeah, it's actually getting better. Let's take a look at return on equity, or ROE. Right now, it's over 11%. Which is a nice step up from its 9% 3-year average. And we see the exact same story with return on invested capital. So what this tells us is that the business itself is becoming more profitable, more efficient at turning its assets into actual cash.
Okay, but we have to connect this back to that crazy stock performance we saw earlier, because this is really the kicker. Over the last 3 years, the stock has given investors an average return of over 35% per year. But the company's actual sales, its revenue, that's only grown by about 1.6% per year. You see the disconnect? The stock story has just completely run away from the business's growth story.
Okay, so let's take a step back and try to put all these pieces together. What is the big picture here for TD Synnex?
So here's what our 3 lenses have shown us.
First, from a performance perspective, we've seen absolutely explosive recent growth. It's like a rocket ship. But through the valuation lens, the stock looks like it's trading at a massive premium, more than double its calculated intrinsic value. And then finally, the health lens shows us a pretty solid business underneath it all. Stable, manageable debt, and it's actually getting better at making a profit, even if its sales aren't growing very fast.
And all of that brings us to the final critical question. Is what we're seeing here a story of incredible momentum, where the market is finally waking up to a healthy, improving business, or is this a classic sign of a stock that's just gotten way, way overstretched, where the price is completely disconnected from reality? That's the puzzle of TD Synnex today.